Hey guys, welcome to Tutorial and See. My name is Daniel, and we'll be considering a topic today in cost accounting named standard costing. So, what is standard costing? Standard costing in the operation of any business, there are various costing technique that should be utilized to help manage and control the costs for the business, and they include process costing, standard costing, job costing, and contract costing. So, these costing techniques are now interwoven in the business system to ensure an efficient and effective control of cost. So, now what is standard costing? Standard costing is the estimation the estimation of predetermined costs, which is then compared with actual costs. Do you understand what I'm saying? So now it is a technique that establishes predetermined estimates of cost of product and services, and then compares this predetermined cost with actual costs as they are incurred. It allows for the establishment of expected cost for materials, labor, and overhead. So we see here now that standard cost is like a target cost that should be obtained, because it's the estimation of predetermined cost for what product and services, which is then compared with what the actual cost incurred for that period. So now, what is variance? Variance now is now the difference between the predetermined cost and the actual cost. We're talking about standard costing being what estimation of predetermined and what actual. So now, variance is now that difference, the difference between the standard cost and the actual cost. Do you understand? So now, what is then the purpose of standard cost? In the operation of a business, why do we need standard costing techniques? So now it helps to compare. See, before I even read the note, the one of the purpose when it comes to standard costing is that this thing helps to control. One of the keyword you see in purpose is control. It helps to control. It helps to establish the selling price for companies, for organizations. Do you understand? It helps to control. It helps to establish the selling price. It helps to measure performance of the business. It helps to measure the performance of the business. And one major thing also, it helps to evaluate stock. So now from what we can see here, we can see that the purpose of standard costing technique is that it compares the predetermined estimate of cost with actual cost. So one of the main purposes that we see here is comparison. It helps to compare standard with actual. It also helps to set benchmark for performance evaluation and cost control. So you can see that from what I was saying before, that one of the purposes of standard costing is control of cost and now setting benchmark. So knowing that this is the maximum, this is the minimum level that we must pass or reach to obtain full efficiency and effectiveness of operation. So now we see here now that note here that predetermined costs are also known as standard costs. Are you with me? Predetermined costs also known as standard costs. So what is variance analysis? So now we see here now that variance analysis is the process by which the total difference between actual cost and standard cost is broken down into different elements. So now, what will you say analysis is all about? We are trying to analyze the variance that we have gotten. And from our previous slide, we see that variance is different between standard cost and actual cost. So now we're now seeing here now that the analysis of those variance is now when you are now breaking down the differences into different elements. When it comes to variance analysis, there are various types of variances. So from the definition that we stated before, that we stated that standard costing is the establishment of cost for what material, labor, and overhead. So now, in the course of the video, in the course of the slide and the video, we'll be discussing more on the different types of these various analysis that can be used to make a business and organization to be more effective and efficient in running of his business. So now, what are the benefits of standard costing for an organization? What are the benefits that we that we incur that we involve to the business for incurring standard costing? So we see here now that standard costing helps to assess performance. Do you understand? So in comparison of cost, we see here that it helps to assess performance. So now you want to assess the performance of last year with that of this year. You are comparing. So it helps to assess the performance. It helps to assist in assessing performance and efficiency. So if you know that from last year, our cost that we incurred in purchasing a product was like, let's say, like 1 million. So for this year, we'll be knowing that things will have increased, maybe due to inflation and maybe government policies. So you see that now that since we cannot assess the performance of last year, we cannot compare it with what has happened this year and find the variance. Then we can get the midpoint. Do you understand what I'm saying? So now one of another merit of standard costing is estimation. So now it provides a basis for estimation and forecasting. So standard costing helps us to forecast. So now when we can know the price of of the period of now for a product, we can now forecast that same product for the next 2 to 5 years. You understand? Knowing the net present value and estimating for maybe depreciation or tax or profit. You understand? So now another merit of standard costing is management practice. It facilitates the prudent practice of management by exception. So when standard costing is incurred by a business, it helps the management to be more prudent, to be more effective in their cost practice, in their cost management and efficiency. Are you guys with me? So now, as we are going forward, we will solve a question under standard costing. But before we solve that question, I would like to explain the terms that we'll be looking for. So now, in calculation for variances, these are the following things that will be required of us in any calculation that you see. So now, I will now be briefly explaining this following content that are here. Material cost variance. So this is the difference between standard price and standard quantity minus the actual price and actual quantity. It can also be the addition of your material price variance and your material usage variance. So now, material price variance. This is the difference between the price set to purchase a given price or services and the actual price that's actually paid for that product or service. Are you with me? So now, another one, material usage variance. This is the difference between the unit of material used in production and the actual unit that was used in production. In the course of the calculation, I will also spill out the formulas for these items. So now, labor cost variance. Labor cost variance, like material cost variance, this is the what? The addition of labor rate variance and labor efficiency variance. Do you understand? And it can also be the is the addition of labor rate variance and labor efficiency variance. So now what's the labor rate variance? Labor rate variance is the amount that was set for payment of workers in the course of production. You understand? So the rate at which the workers worked. So the difference between the predetermined price that was set to pay them and the actual price that was not paid to them. The labor efficiency variance. This is the difference between the time set for the what for the production of goods and services and the actual price that was now taken to complete the task and the production process. Do you understand? So now overhead expenditure variance. This is the difference between the standard overhead cost and the actual overhead cost. And it's in overhead expenditure variance that you now see absorption, under absorption, and over absorption. So now let's take a look at this question. We see here now that Okonjo Fashion Enterprise uses standard to control the productivity of what the worker in the month of March 1995. And the following standard was set for the production of 700 maxi ladies gown. So now we are seeing a table here which shows us the items of cost, the standard unit, and standard price. So the item of cost, which are the material, labor, and overhead, and the standard units, which are the 3,500 yards, 4,900 hours, and standard price showing us 60 naira per yard and 50 naira per hour. And the overhead price is 2,800 naira. So now the target of 700 maxi ladies gown was produced, but the actual cost incurred for the mount are given below. Items of cost: material, labor, overhead. Actual unit: 3,100 yards, 4,500 hours. Actual price: 85 naira per yard and 17 naira per hour. And we see here also that the overhead cost is 3,100 naira. So now, if you can recollect that in the beginning of the video, on one of the pages, I told you guys that I was going to continue the explanation on these following types of variance analysis that I'm looking at. So now we'll be working with these 7 types. Because of that, what is required of us to solve this question. So like now, you are required to calculate for the enterprise the following variances: material cost variance, material price variance, material usage variance, labor cost variance, labor rate variance, labor efficiency variance, and overhead expenditure variance. So now, for the first one, the material cost variance. So the formula for material cost variance is what? Our standard price times our standard quantity minus our actual price times our actual quantity. So now let's get the items from this person now. So you see here now under material, our standard price is 16 naira per yard. 16 naira per yard. That will be what times our standard quantity, which is what 3,500. And our actual price is what 85 naira per yard. And our actual quantity is what 3,100 yards. That is 210,000 minus 85,000, 3,100. That is what 263,500. So now, if you less this together, what will it give us? 53,500. And I want to bring to your notice that since we are solving standard cost here, and standard cost is like a target cost. That means that it's something that we are meant to attain, right? We're meant to attain the cost. And since our actual cost, because this is like standard cost minus like actual cost. And since our actual cost here is now more than our standard cost, it's going to be an adverse. Do you understand? It's going to be an adverse. Because we are trying to attain 210. We now went above 210 by attaining what 263,500. I guess saying something. So now this is an adverse. It's going to be favorable when this is going to be lower than this. Like now, I plan to spend 5,000 today, and I end up spending what 6,000. You understand? I passed my what standard price for today. So the adverse is going to be what 1,000. So that's what I'm trying to say here. So this is going to be an adverse. So now the next one is what material price variance. Material price variance. So formula for material price variance is what our average quantity into bracket our standard price minus our actual price. Our standard price minus our standard minus our yes minus our actual price. I guess see something. So now material price variance. This is formula. The actual quantity into bracket our standard price minus our actual price. So now let's get right into it. Our actual price is what? For material. Our actual quantity is what? 3,100. Our standard price is what? 16 naira per yard. Our actual price is now what? 85 85 naira per yard. So this is going to be what? 3 1 into brackets 60 minus 85. That's what? Minus 25. And when you times it together, what will give you? Will give you what? Minus 77,500. So since this is negative value, this is what going to be what? Adverse also. I say something. So this is also adverse. Due to the fact that this is also a negative value, it's going to be adverse. Material usage variance. And the formula for this is what? Our standard price into bracket our standard quantity minus our actual quantity. I guess something. This is the formula. So now let's get the variables now. Let's get the variables now. So the variables will be what? Our standard price here is what? For material. Our standard price is what? 69. Into bracket standard quantity 35. Actual quantity 31. If you do the math, it will be 60 into bracket 400. I guess so that'll be what? 24,000. So we are seeing here now that the values we are getting is positive. That means it is what? Favorable. I see. So that means now the variables there are what? Favorable. So it will be favorable for the business to undertake The for material usage variance is a favorable what variance. I see something. You bear witness with me that in the explanation of calculation, I I said something that another formula for what for another formula for our material cost variance is the addition of material price variance and material usage variance. So now let's see that out. So I said that what material cost variance is the same thing as what the same thing as what material price variance minus plus material what usage variance. So what our material price variance is what minus 77,500. That's what 77,500 plus what our material usage variance is now what 24,000. So now if we do the math, this should be what 53,500 minus 53,500, which is also what adverse. So now you bear witness with me that this negative value 53,500 is also the same thing here, 53,500. So you can say that it's the same thing. Material cost variance is the same thing as the addition of material price variance and material usage variance. I just so now let's continue. So now we'll be entering into labor. So now our labor cost variance now. Like now, since material cost variance is the same thing as the addition of material price and material usage. Same thing here, so our labor cost variance is also the same thing as our labor rate variance plus our labor efficiency variance. And there's also a formula that we'll also be using, which is what our standard hour times our standard rate minus our actual hour times our actual rate. I guess it will. So that will be what our standard hour here is what for labor. Our standard hour for labor is what our standard hour for labor is 49 hours, 4,900 hours. That be times what our standard rate is what 15 naira per hour minus our actual hour is what 5,000 hour 4,500 hours, and our actual rate is what 17 naira per hour. So if we put inside calculator, that will be what 49 times 50, that is 245,000 minus what 45 times 17, that's what 76,500. I guess so. So now if you do the math, if you less it, this is what a negative value of what 168,500. So that means this is what this is what an adverse. So this is not favorable. This is adverse because of what the standard is more than what the actual. So this is adverse. I guess it's me. So now let's move to the next one. Next one is what labor rate variance. Labor what rate variance. This formula. So our actual R into bracket our standard rate minus our actual rate. So now what is the variable here? Our actual R is what 4,500. Our standard rate is what 15 naira per hour. Our actual rate is what 17. So that will be what 45 into bracket 50 minus 17. That's what 33. And when you times that, that will give you what 148,500. 148,500. You understand? So since we are seeing now that this is not a negative value, that means this is what favorable. I see something. This is what favorable. I get it. So now let's move to the next question. Labor efficiency variance. Labor efficiency variance. Labor efficiency variance. And the formula for this is what our standard rate into bracket our average. Let me start with standard. So flow more. Our standard R and our actual R. I guess it. I guess it me. So our labor efficiency variance is this formula. Our standard rate into bracket standard hour minus actual hour. So now the standard rate for labor is what? That is what? 50. 50 naira. Our standard hour is what? 4,900. Our actual hour is what? 4,500. So when you do the math, that will be 50 into bracket 400. So that will be what? 50 times 400. That is what? 20,000. And that is what? Favorable. I guess it. I am that's a favorable one. So I want to show you guys something again. You know the other thing I told you guys when we were solving for material. We know the same thing for labor. That our labor cost variance is the addition of our labor rate variance plus our labor efficiency variance. Okay, that is what our labor cost variance is the what labor rate variance plus labor efficiency variance. That is what 148,500 plus what 20,000. So that was what 168,500. And what did you get it? I guess it's something. So you can see that it's the same thing. So now over to the last question. Our overhead expenditure variance. So overhead expenditure variance is like what I said before, is very simple. So in here, we'll not be doing our standard overhead minus our actual overhead. So that is what 28 minus what 31. And that'll give us what? That'll give us what? 300 naira. 300. And since our standard is lower than our actual, that means what? It's an adverse. Because we plan on spending 2,800 and we ended up spending what? 3,100. So this is what? Adverse. You understand? So now we are done with this calculation. So now this is one of the simplest questions you see on standard costing. So I want to endeavor you guys. I want to tell you guys to go and practice more questions from textbooks or check YouTube for questions like this. This is another question. So I want you guys now to go and solve this on your own. And we'll be posting the answers as time goes on for you guys to be able to construct your answers that you got also. So you can compare the answers that you got. So I say now when an attainable standard achievable under the best possible conditions, when there is idle time, when the same trends have been maintained over a long period of time, when allowances are made for normal losses and possible machine breakdown. So you bear witness to me that the answer here is D. That attainable standards are achievable when allowances are made for what normal losses and possible machine breakdown. I guess so. So now question 2. Standard costing information is used to ensure that what A. Losses are made in the sales of goods produced. Abnormal profit is made. Production goes on smoothly without disruption. And raw materials are being purchased at reasonable price and used reasonable to avoid waste. And E. None of the above. And also for this question, we can see here from our definition and all that standard cost information is to ensure like now let us even use elimination method to answer it. Standard costing, does it ensure that losses are made? No. Does it ensure that abnormal profit is made? No. Does it ensure that profit goes on smoothly without disruptions? And does it ensure that raw materials are being purchased at reasonable price and used reasonable to avoid waste? So you can see that D is more of a correct answer than C self. I guess so the answer here is what? D. I something. Because you using standard costing information. That doesn't necessarily mean that your production will go on smoothly without disruption. Do you understand? Because standard costing techniques is standard cost information. It's just a comparison between our what our predetermined cost and our what actual cost. Do you understand? So now the difference between historical cost data and predetermined cost data is what? Our variance. Do you understand? So that is what variance, not standard cost, not overhead assessment, not standard setting. Variance. I guess. So now, dash is the difference between standard units and actual units of material used. So you will bear witness with me that in the course of this video, we explained what the various types of what various analysis. Do you understand? And one of them, I define that it is the difference between standard units and actual units of material used. So this itself gives you an hint that the answer to this is what material what usage variance. I guess. So now we see here now that dash is a school of thought which believes that every standard must be based on history or statistics of past operation. So I know that in the course of this video, we didn't explain so much on this, but we'll see what we can do on it. But also endeavor you guys, because this is just a brief explanation on cost accounting. So like what I said before, you guys should go back to your textbooks and YouTube and what read more on this topic. So the answer for this question, even though we didn't talk more on it, is what the historic cost group. Do you understand? And standard costing is also used to control and measure the what that's with which the organization pursue its goals. To measure the what efficiency with which the organization pursue its goals. That's what I'm saying. So now I want to thank you guys for joining me in today's class. See you next time.